In 2019, a 41-year-old contractor named David Miller died of a heart attack, leaving behind his wife and 3 kids. He had life insurance, $100,000 worth. It was gone in 8 months. His family lost their house the following spring. This isn't rare. Studies show that 40% of American families who lose a breadwinner fall into serious financial hardship within 6 months, even when they had coverage. The problem isn't that people don't buy life insurance. The problem is that almost nobody understands what they're actually buying. And the insurance industry has made that confusion very, very profitable. So let's fix that right now. Life insurance is a contract. You pay a monthly or annual premium, and if you die while the policy is active, the insurance company pays a lump sum called a death benefit to whoever you name as beneficiary. That's it at its core. The purpose is income replacement. If you have people who depend on your income, a spouse, children, aging parents, life insurance ensures they don't suddenly have to survive without the money you would have earned. Think of it this way. Every year you're alive, you earn money. If you earn $50,000 a year and have 20 years left in your career, you represent $1 million in future earnings to your family. Life insurance protects that $1 million. When you look at it that way, the premium you pay isn't a cost, it's a hedge. You're protecting a $1 million asset. Now, here's where David Miller made his mistake, and where millions of Americans are making the same one right now. There are 2 main types of life insurance: term life and whole life. Term life is straightforward. You choose a coverage period, 10, 20, or 30 years, and a benefit amount. If you die in that window, your family gets paid. If you don't, the policy expires. Whole life is different. It covers you for your entire life, combines a death benefit with a savings component called cash value, and costs dramatically more, anywhere from 5 to 15 times more per dollar of coverage. Here's a real example. A healthy 35-year-old man can buy a 20-year term policy with $1 million in coverage for around $30 to $40 a month. The same $1 million in whole life coverage costs anywhere from $800 to over $1,000 a month. Now, an insurance agent will tell you that the extra cost is justified because whole life builds cash value, a savings account you can borrow against. But here's what most people don't realize. If you bought term life and invested the difference, that's $700 or $800 a month you saved, into a basic index fund, over 20 years you would likely end up with far more money than the whole life policy ever accumulates. This is the buy term and invest the difference strategy, and it's what most financial planners recommend for the vast majority of people. Okay, so you've decided on term life. Great. Now comes the question most people get wrong. How much coverage do you actually need? Many employers offer a policy worth 1 to 2 times your salary as a free benefit. And many people think, great, that's enough. It is not. Here's the dime formula, and it's the simplest way to calculate real coverage needs. D stands for debt. Add up everything you owe: mortgage, car loans, student debt, credit cards. I stands for income. Multiply your annual salary by the number of years until retirement. M stands for mortgage, your remaining home loan balance. E stands for education, the projected cost of college for each child. Add all of those together. That's your coverage floor. For most middle-class families, this number lands between $500,000 and $2 million. $1 million sounds like a lot until you do the math. If your family invests your death benefit and earns a 4% annual return, $1 million generates $40,000 per year. That's $3,300 a month. Is that enough to cover your mortgage, kids' activities, groceries, and utilities? For most families in America today, the honest answer is barely. And remember that principal gets spent down too. So when people buy a $100,000 policy, like David Miller, they're not insured. Now, let's talk about something the insurance industry really doesn't want you to know: how your premium gets calculated. Because if you understand it, you can use it to your advantage. Insurers use actuarial tables, massive databases of mortality risk, to price your policy. 5 factors dominate. First, age. Every year you wait, your premium increases significantly. A healthy 25-year-old pays roughly half what a 35-year-old pays for the same policy. Second, health. Insurers will ask about your weight, blood pressure, cholesterol, and family history. If you're on the borderline, losing 15 pounds or getting your blood pressure under control before you apply could save you hundreds of dollars per year. Third, tobacco use. Smokers pay 2 to 3 times more than non-smokers. If you've quit for at least 12 months, apply as a non-smoker. You can qualify. Fourth, the coverage amount and term length. A 20-year term often costs only slightly more than a 10-year term per month. Lock in the longer term when you're young. Fifth, the insurer itself. Rates vary by 30 to 50% between insurance companies for the exact same applicant. Always use a broker, someone licensed to sell from multiple companies, not just one, to compare quotes. Let's go back to David Miller for a moment. His employer offered him a $100,000 life insurance policy as a benefit, and David signed up for it thinking he was covered. He never thought about whether that number was actually enough. His wife, Karen, was a part-time school librarian. They had a mortgage, a car payment, and 3 kids ages 8, 11, and 14. $100,000 sounds like a number with a lot of zeros, but against a $300,000 mortgage, 3 kids approaching college, and a household that needed Karen's income to stretch into a full-time salary, it evaporated. Karen Miller now works 2 jobs. She sold the house in 2020. The lesson isn't that David was careless. David was like most people. He did what his employer suggested, signed the form, and assumed someone else had done the math for him. Life insurance isn't complicated, but getting it right requires someone to sit down, run the numbers, and actually think. Use the DIME formula. Compare at least 5 quotes through an independent broker. Choose term over whole life unless you have a very specific estate planning need. And start today, because every year you wait is money your family will never get back. If this video helped you understand something that your insurance agent never explained, hit subscribe. We break down the real numbers on life, health, and auto insurance every single week. Your financial future depends on what you know.